Hey, welcome everybody. It's the Mohawk Forex team back for NFP day, our favourite trades of the whole month, and it's good to be back. A little break. Live from London and from the USA.
I think it's going to be difficult, but I think our message, Tom, has been quite consistent. We've been seeing that this is longer.
Love it. It's actually a nice sunny day today in London, even though we're meant to be autumn. It's still nice and sunny, so it's good. Everything's geared up for a good NFP. Markets are highly volatile, which we like. Everything's all over the place after all the Fed news and interest rate rises in the UK and in the US, and then the talk of a 2-year recession in the UK by the Bank of England yesterday. So, and all this NFP reflects will affect everything, the European market, British market. So, you know, there's a worldwide picture. That is why these data and fundamentals are more important than they've ever been when we're scalping, because they just move the markets way more than they used to 2 years ago, I'll say. So an NFP is looking, the consensus, to be 200. Some people are saying 195, so slowing down in the jobs market. But the secret word is, so they're saying, is it's going to be higher, which if it is, probably will push stocks up higher through the roof, because that means the Fed's more likely to hike interest rates and the banks win from that. So that's kind of how it works. Not always, but that's how it should work. If on the other hand this is like lower, like 180, 160, 150, and then we might get a decline in stocks, US 30, etc. We might get a reversal on gold. Gold might decide to go the same way. We'll just wait and see. But that's kind of the thing. But the feeling is in the background that actually this figure is going to be higher than last month, 263, or somewhere in the middle. In which case we could see things move quite quite wide. So we're going to get in, get out as many trades as we can. We're using our bigger account. We've been trading a small account all for the last 2 weeks just to practice, show people how you can true scalp with $200, $300, $400 accounts. We're going to be using a bigger account today because obviously I'm expecting some wicks and drawdown, and I don't want to be stopped out, or my account stopped out, or stop lost out. So I'm going with a bigger account, but we're still going to trade the same way, small lot sizes on gold. Just have a look at gold. Here we go. Set up nice on the 5 minute. I'm going to do 0.4, and this is all for your entertainment, of course. No financial advice given. I wish we could. Can you get? That's it. You got it. We do our best. But things can move so fast. I mean, here on the 5 minutes, as you can see, gold has been pushing up nicely. And this is a reflection of the current markets getting back up 1650. So NFP could take this higher. And obviously the good thing about using our grid, we've got our points of interest grid, which is support and resistance and Fibonacci all blended into one, is it's giving me definite levels of where I could look to take profit in whichever direction. And obviously I'm looking just below here for it to smash through that. We'll have that as a TP1 potential. And then on the flip side, on the low side, I'd see it breaking this level here and probably going down to this level here. It depends where it finishes in the next few minutes or so. We've got about 20 minutes to go, so it's quite a decent support level here. But if you could put that as a TP1 on the sell side, and then we will look if there is a big difference in the result, which most months there has been, then we could see a sell-off. So they're my levels. So, and I don't look at the particular numbers because your broker's different, but obviously I look at what I can gain, and we're talking 85 pips to the top side and a minimum of 45, and then a possible 1300. So that's a big jump. So that would do, you know what I mean? I'm looking to do multiple trades and try and get in and out about 100 points, 10 pips kind of mark. You want the when you click the button, you want the market to instantly hit your TP. That's the way it is, doesn't always happen, but that's what we try and aim for. And also remember, if you miss the initial move, which you will do because the market will move before the news result comes out, that's the manipulation. Don't panic, because just wait for it to wick down. That's what we always try and do, because the market usually goes in the same direction as that initial big move. Then once it hits an area of support and resistance, then we get the pullback and we'll trade that, and then we're done. Bang, done, and then we're on to the open. That's it. Sounds easy. I wish it was. I wish it wasn't stressful, but we love it. It's true scalping, That's it. And there's two ways to do it. Is either use a bigger account so you're not scared about the drawdown, because you're going to get drawdown. You just always people who panics when you see your account in the red. This is not for you. But if you get the direction right, it'll come back to you, including the spreads and commissions. Or the other way to do it is have a separate account, which I do sometimes, and load it with just the amount you're willing to risk to lose. Say $200, $300. So you go all in, and you either make 10%, 50%, whatever, or you lose the lot, and you've got to be prepared for that. And that's a good way to do it as well when trading fundamentals, if you don't want to risk everything in a big account, if you're a newbie to trading fundamentals and kind of true scalping. So that's the only kind of advice I would give, is always trade with money you can afford to lose and you're not going to cry about. You don't want to be your life savings or anything. Oh, lemon and ginger tea today. That's nice. So that's gold set up there, as you can see, and we're going to get a continuation up to about the 1660, or we're going to get a pullback to the 1630. We shall see. The line is in the sun there. Sorry, mate, go on.
Employers added 195,000 jobs in October, and it sees the jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point
And look at US 30. This is the thing at the moment, you see. We're used to the fact that, gold and US 30 usually don't correlate the opposite way, but as you can see, look, they're almost pretty identical. So we could see a rise in the US 30 in stocks if the news is better, the result is higher. And also we could see a push up on gold at the same time. Then one of them will reverse. It's usually probably the US 30 that will reverse first, and vice versa. If, like Justin says, the news is weaker than the 200. I mean, they're predicted 195-ish. So if it was 151.40, that would actually, I would suspect, pull the US 30 down, and maybe gold as well, and then we'll get a reversal on the open. But like I say, they've been wrong so many times, and there's such big influence put on this. They're expecting the unemployment rate to have crept up from 3.5 to 3.6, and obviously earnings to have dropped from 5 to 4.7. So they're the important figures as well, not just the initial actual release. We're looking at the earnings. If the earnings are dropping, unemployment rates climbing, and the payrolls are dropping, then obviously that means, not a start of a recession, but that the market is declining, and the Fed's work of trying to contain the economy is working. A shrinking economy is what they want to get the edge on inflation. If all that blows out of the water and goes the opposite way, then we're going to get some really big moves, I suspect, on gold and US 30. So it is just a case of getting in as quick as you can, like Justin said, and getting out. And obviously I will trigger as many trades as I can. Half of them don't get filled by the broker. You've got manipulation, you've got big spreads, all that, but there's such a big move potentially here. That's it. Yeah, and you've also got to think that the moves are so big it will eat up any spreads and commissions. But what you don't want to be doing is entering right at the top of a candle or right at the bottom of a candle when it's against a support zone. Now, chances are it will continue, but you will get a wick back that will probably scare you and go, oh my god, and then you end your trade, and then guess what, it goes back your way. Like I say, if you miss the initial move, which we all kind of do, wait for the pullback on the candle, then go in. If it doesn't pull back, don't enter the trade. There will be a pullback, there will be a wick down, then you enter. Get the continuation, wait for things to sort out, look at the RSI, look at the momentum indicator, look at whatever other indicator you use on your chart to give you an idea of where it's overbought or oversold and there might be a pullback, and then trade that. That's, so Justin's quite right. Bloomberg are getting ready. We've got that logged in as well. We're about 40 minutes away. So US 30 and also pound dollar cable. Look, as you can see, we got a trade there earlier on. We managed to bag our 10 pips. It actually was set a target at 24. I got out at about 10. Then it's pulled back, and again that was a cheeky trade, just purely because I usually don't trade cable on an NFP day. As soon as I saw our trend line break here, I was already out of the trade anyway at 10. I just caught that from the 8:30 entry, look, which was here. You can see, look, up to that wick was 27. I was out at 10, and then it pulled back. But this will fly as well. NFPs in the lines in the sand there. So, but I'd rather stick with, as I always do, gold, and then getting back in on the US 30. That's just coming out of our moving average cloud now, look, coming down. The markets, that's a nice signal, look, as you can see, look, when these trend line breaks and you get the signal, they work really well, look, both, 1, 2. But I don't want to be any trades at the moment, obviously. We don't want to be getting caught up in anything. Yeah. Yeah, 100%. That's what it's all about with these. people do set pending orders. I understand that, but that's not the way to do it, because the market knows that. It can see billions or hundreds of or thousands of traders pending orders for NFP in every news event, and they always. There was one the other day, I can't remember who it was now, and I saw a massive wick down. It took out everybody, and then went the way that I went with it. That it should have done. But it dipped straight down, almost like wow. And it was a pure manipulation. Everyone who had a buy pending order would have been stopped out, and then guess what? It went straight back up and would have hit all their TP. So that's why I don't do pending orders on news events. I know people have got the technique of doing that. I think you're better off just entering live, and we're getting a broker that's got a decent execution, and IC markets I'm with as good as anybody.
So there's just a lot more momentum in the U.S. economy. Europe and the UK are dealing with a much bigger rise in energy prices, and they have a war on their doorstep. We don't think the unemployment rate's going to rise soon.
Dean Mackey there of Point72, the chief economist, and Tom, I think he hinted at modelling maybe what Aaron Judge to Queens would look like.
No, he did not.
To the economy.
He ran away.
Did he deny it?
He ran away. He was like, please.
I could see Steve Cohen's shadow behind him.
Yes.
Steve was just off to the right side.
Seriously,
of the camera.
Bramo, don't ruin a good story.
I'll try not to.
0.6% on the S&P. Payroll's about 12 minutes away. We're looking for 195k. Equities up, yields higher by almost a basis point on a 10-year. 415 on 10s. If you just check out what's happening at the front end of the curve, and we've been doing that all morning.
That's it. You got it. You're just showing your hand. That's why I always see it. It might be paranoia, and you might think, well, I'm only trading a few dollars, what's it matter? But the thing is, if you've got a pending order set on a particular support and resistance or whatever, guaranteed there'll be hundreds of other traders doing the same thing. Everyone reads the same charts, everyone looks at the same thing, people trade the same indicators, so everyone's entering at the same kind of thing, like Justin said. So obviously markets know, yeah, there might be, if you've got 1,000 people all risking $100, I'll have that. But then you might have a whale in there who's sat on there investing 10,000 in a trade, and we'll take him out as well. So if you don't show your hand, how can anyone go the market against you? If you lose a trade because it's your own fault, then that's fine, but to lose a trade because someone is manipulating is a hard pill to swallow, and we've all been there, so that's my take on it anyway. Obviously, I'm not saying pending orders are totally bad and they're okay for swing trades and longer ones and stuff, or if you're sleeping or whatever, but when it comes to news events, I would avoid doing pending orders, and market opens and stuff like that.
So I think theory still helps, but the data may be a little different than, and the underlying structure of the economy may be a little different than 40 years ago.
Let's go to your wheelhouse, Newtonian calculus and its use in finance. What is the rate of change in the second derivative we're observing right now, the rate of change of the rate of change? What do they signal to you?
So I think what the Fed is looking for is really waiting to see whether the labor market is going to crack and find some cracks in the labor market.
You got it. That's it.
Has been very strong.
It all adds up, doesn't it? That's the thing.
Continue to create a lot of jobs, continue to have low unemployment rate, continuing to still have a lot of job openings relative to the number of unemployed people. And I think what the Fed will be looking for is some impact of its policies on the labor market. We've seen it in the housing market. The markets clearly now have gotten it that the Fed's going to be raising rates probably into the 5s. That's why the 2 years at 4.75 where it is, and so that's why the job market now and the one that'll come next month will be so important for what the Fed does.
That's it. Yeah, we're the small minnows in the mix, aren't we?
But they seems to have really received the message that the Fed is putting out there, that Fed Chair Jay Powell is putting out there. Is the message that rates are going to be above 5%
Yeah, that's it.
the bulk of next year? Is that the correct message as correctly being priced into the markets?
I think that's the reasonable likelihood. Now, obviously, how far, whether they will go above 5% and how far above will depend on labor market numbers now next month, the inflation reports. But I think we're very likely to get.
So you got a nice sell signal on US 30 as well. Look now, so that was that could have been a nice counter trends. I love our trend lines. And again, this is all the AX trading system automated. All these things are drawn on the chart for you automatically. So all you've got to do is really just spot the setup. We try and make it as easy as possible. Obviously, with trading news events and opens, it's different. That is down to the individual, their risk management, and their eye, But outside of that, or normal scalping, all this system is here just to help you, you know, find an entry point. The exit point I always leave up to the individual, because as Justin will back me up, we don't believe in this kind of risk to reward ratio. It just doesn't stack up. I actually spotted a guy the other day on YouTube. I can't remember his name now, and he'd actually worked a formula out for using the RSI to work out the proper risk to reward. Because he agreed with me. He said, yeah, there's no such thing as a 1.5 or a 2, or you're entitled to that just because you're risking whatever. You should only go for 1.5. You go with what the market gives you and shows you, and he's worked out a formula. I'll have to try and work it out how to do it using where the RSI is from when you take an entry point, and then he does his stop loss, and then he calculates what the risk reward is, and he was like 1.215 to 1 or 1.53 to it. But he was bang on, and every time he set it, it worked really well, and he says that's the way to do it. It's a proper formula, not just automatically assuming, you know, my strategy is crap unless I get a 2 to 1 on every single trade. I mean, it doesn't happen. If you could get a 2 to 1 on every trade that you entered, so, you know you're not going to. So why enter that? That's what I don't understand. These people who backtest and do 100 trades on someone's strategy and pull it apart. They just set it at 2 to 1 or 1.5 to 1 and then say, oh, it's a bad strategy because it's only 40%. Well, that's because who says you're going to get, why should you get 1.5 on every trade you enter? You're not going to. It could be more, could be less. That's just, I never understand that, you know.
But Bloomberg has an actual whisper number.
Bloomberg has an actual whisper? I did not know.
WHIS go, and
you can enter
your own number. So if you have a number you want to put in there,
I can do this?
You can do this.
Wow.
Well, Randy, and I know that you're here listening to this, and if the whisper is correct, and we do get a higher than expected number, does that change where you see the Fed going in terms of how much they have to do to really undermine some of the momentum?
So they're going to keep going until they see some slowdown in the labor market. And if that means, you know, if we get a really strong number this month, we get a really strong number a month from now, inflation is still not coming down, they're going to be moving. They might even move 75.
Yeah, well, it's people trying to make something mechanical, which is the ideal. Into everyone would love that, where we almost trade like a bot, and you know it's set, and you wouldn't have the stress, and you wouldn't have to put the effort in to learn how to scalp and trade, because you just set your levels, walk away, and if it hits your stop loss or it hits your take profit. And that's kind of what all these people do when they backtest in their strategies. But why take the losses? Like you just said, okay, you might have smaller wins, but you'll have more wins, and you can eliminate the losses. You're setting yourself up to lose by setting those kind of levels based on what? Based on I'm risking this, therefore I must get this back, or it's not worth taking the trade. That's every trade's worth taking if you're going to get some green, like you say, whether that's $1, $10, or $100, as long as the setup is right. This is why I don't ever give out advice on where to take profit. That's totally up to the individual, because there's so many conflicting things out there, and people will disagree with me or whatever. But you know, I just get in, get green, get out, and then look at what I've stacked up at the end of the day. You know, I don't ever. I mean, anytime I've ever done that, I've done a risk reward like in the old days. I've lost, because like you said, I've gone, oh, it's almost going to hit my take profit. Yeah, I won't end the trade. I won't end the trade. Then, like you say, before it hits your TP, bang, it drops all the way down. You go, damn, and you feel pissed off, and you go, that's it. Yeah.
We are at the point of where the economy develops in a faster pace. Progressive growth makes the demand for market.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen
Yeah.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business?
Yeah, you got it, you got it. Right, here we go. We're on the countdown. So I've just logged in. I'm on gold. I'm going to do 0.4. I've set some preset TPs. Good luck, everybody. Like I say, try and get in and get out, and let's see what the result is. We'll look at the headline figure. Obviously, Bloomberg is a little bit behind, but we'll just turn it up so we can hear it. But they will, and we'll see the move first. Look at gold. Is gold going to shoot straight up? This is what we're looking for. Look at that result. 30 seconds to go. So like I say, I predict if this is higher than 200, we're going to get a shoot. Let's see. I'm on the 5 minute, looking now. Is gold going to shoot down or up? There's the levels I've already set, TP1, TP2. Yeah. Get ready. Oh, what a sell. Yeah, let's get in there. Let it fly. Look at that.
From more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
Go for it, go on.
This is Bloomberg Technology. Welcome to Bloomberg Crypto.
Keep pushing. Yeah, it's a great wick, that is. So let's have a look at the quick while we're holding it. Let's have a look. The actual results. Here we go.
Yields going nowhere on a 10-year
261.
Here's Mike McKee.
We talked about an upside surprise, and an upside surprise is
yeah, 261. Well done. Look at that.
That is much higher than the 193 that was anticipated, and 233 in terms of
higher than expected. You see, there you go. Higher than expected. Let's have a quick look at US 30. Look at that, dropped like a stone.
The revisions, 29,000 positive from the prior month.
Yeah, I'm just going to try and get in on US 30.
290,000 jobs we didn't know existed before the month of October. Unemployment rate ticks up to 3.7 from 3.5. It was 3.7 in August, fell back to 3.5 in September. So 3.7, progress in the right direction in terms of unemployment as far as the Fed is concerned. Average hourly
just clearing out my US 30, and I managed to get $100, $200, $300 on US 30, just trading to 0.2. Just print that, and that's the sales on US.
Probably without me looking at it directly, for why the unemployment rate went up. So, John, how are people taking this?
Well, Mike, right now we seem to be trading on the upside surprise in the headline number and maybe not that unemployment story, but we can build that out. As you know, the first move, not always the right move when it comes to payroll, so we'll let this breathe, but I'll go through it as it stands. Equity futures now unchanged. They were positive on the S&P 500. We've talked a lot about the front end of the yield curve, the 2-year, up 7 basis points now, just short of 480. We came very close at 479.90. Yields up, stocks down, rolling over, and guess what's stronger? The US dollar, euro dollar.
Yeah, US dollar stronger.
Positive by about 0.2.
So gold should pull back. Let's wait and see.
Back down to 97.68. TK, it's an upside surprise on payrolls, and that seems to be
try and enter some sells at the top there.
It might change in about 60 seconds time, Tom, but at least for now, good news is what is it, Tom?
You're busting my chops here.
Yeah, I'm just closing my trades on gold right now. Come on, come on, come on, come on. We've been trading 3 minutes, and we managed to get, we cleared 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 positions, and that was $200, $300, $910 altogether. Ooh, in 3 minutes. The idea was 1,000.
Want to see the labor market slow down because they think that means the Fed is going to be able to do less or may not have to do more, depending on how you want to look at it.
I'm going to see if we're going to pull down some more. Look, we've still got that sell. Let's have a look.
From 6.7%, and you look at the breakdown on an ethnic basis, which is what was the Fed's big thing before the pandemic. Black.
Yeah, I think we're still going to
5.9%. That's up from 5.8.
Get 16.
Asian 2.9 up from 2.5, and Hispanic.
Let's see if it goes down to that 16.45 level.
3.2 up from 3.1. So every ethnic category saw an
US.
increase.
Look at that! Look at that rejection on US 30. Ooh.
Which is kind of what the Fed sort of expected.
Well, but the other thing that is perhaps giving people pause is the month-over-month increase in wages, which actually came in hotter than expected.
Gold again. Right, it's going to end some more trades.
How much does this really underpin that the people who are getting jobs at higher wages?
Cool. We just got another 70, 100, 100, but another 200. 1,094. Yes. So there, we've hit our target. 1,094.
So it's not helping. The question that the
in 4 minutes of trading. That's what we're all about.
Is whether or not people demand to keep up with inflation. So inflation's got to come down, or wages have to go up, or people are going to be rather dissatisfied. Now, as we fill in,
yeah, but it's still going to bounce off that 1650, I reckon, and go back down again. What do you think?
Starting to come down from 4.7. It was 5% in the month of September. It's coming down slowly. But the one thing I've noticed as I go through this report is that even with gains of 261,000, they're pretty widespread. The categories themselves, category by category, have slowed down some. Leisure and hospitality. Remember, we were getting hundreds of thousands a month. We get 35,000, and so you're starting to see some contraction there. Manufacturing 32,000. That's still hanging in there. But construction, only 1,000 during the month. And that's kind of odd. I would expect that to go up just because of Hurricane Ian. Everybody's got to move to Florida and start rebuilding down there. There is no note that I see about Hurricane Ian in this employment report. It took place after the September one, but before the October one. So apparently it didn't have enough of an impact that it would be. Here's a little bit of note. No discernible effect. That's what I was anticipating.
Yeah, beautiful.
So there's the data, folks, as we digest this. I know 289,000 3-month moving average is the number I look at. John and I are looking at 4.77%, up 5 basis points in the 2-year yield. Randall Krauser knows these are abrupt moves. He mentioned that earlier. He is at the Booth School, the former.
Is he going to hit that 1660 as I put there?
Student of economic history. Let's say we get a terminal rate of 5.x%. Let's say we go back to CD rates of a time.
So we hit our TP1, you see, which I set at 1645. Let's see if this is going to push.
Structure that we know, or are we in new territory?
I don't think we're going to be going back to interest rates at double-digit levels, which is where we were.
Nice buy signal there.
Inflation was this high 40 years ago. So I don't think the Fed is going to need to go that high. But I think, as you can see, with the 2-year moving up, the
unemployment rate was up. You say that's what pushed the markets down.
Not seeing cracks in the labor market yet, and so the Fed is going to have to continue on its path, and its terminal rate will be a bit higher than we thought.
What do corporations do? How do they adapt as we see the nominal yield and the real yield come up?
So I've closed everything. That was the target. 1,000 in a minute. We did 3 minutes, 1,094. So that will do nicely, but we'll just see. But yeah, look at that, you see. So the claims high, jobs created higher. Unemployment rate was higher though, and earnings was the same. So obviously the employment rate is what helped push the market down, but the main figure, as we said, would be, look at that, buys on US 30 and buys on. So almost that red candle was the manipulation.
For a couple of minutes, and equities have raised the losses post payroll. So the S&P 500 is back up higher by 0.8%. That move at the front end has faded back to basically where it was going into.
If you've got a big enough account, you could hold that. You know what I mean?
4 basis points or so. I don't think this is the game changer at all for anyone out there. And by the time we get to
Let's watch
CPI
gold.
November 10th next week, we won't even be talking about what's just happened here in the labour market, Tom. We're still waiting.
Let's see gold push up higher.
To get a better understanding that the dual mandate of the Federal Reserve is in conflict, and right now for the Fed, it's not. I'm going to have this conversation with
Let's get rid of
Rick
that.
over at BlackRock in just a moment. Anastasia Amoroso of iCapital, Mike Collins of PGIM, and we will catch up with Secretary Marty Walsh, Tom, of the Labour Department of this administration. Looking forward to that a little bit later in the next hour.
Very good. We'll continue with futures up 30. The VIX comes in 24.
Let's see if how this is going to play out. And on US 30, exactly the same look. So you could almost say this was a manipulation candle, but look at that, you got wiped out. But again, look at our grid, it was spot on. If I'd have been trading US 30, I'd have said to you guys, there's your potential TP, and here's your potential TP. And look at that, smashed it. So that's the only thing you can set is around that area to take profit using our grid, and you would have done it. You know, your stop loss is a different ball game. You don't want to be using a stop loss, like I say, because you just get wiped out. But your TP, you could have set that, and it would look, it hit it, and now there's a chance it's going to hit that 32289. Like I say, the market's going to just chill out a bit now, but we've got 45 minutes till the open. You always get this in NFP, the pullback, and then bang.
A chance to dig into the details of the report, but that's obviously something one needs to look at. The Fed will be heartened that we're not seeing an acceleration in the
but well happy with that. We caught that move really, really nicely. And again, all we did was to wait for the move, wait for the wick, and then enter again. And then after a couple of times, that's it, because you know the market's going to reverse, which it has done. You can see it's pushing now.
I want you to jump in here, if you would, right now. I'm watching Mike, folks. Look at the real report, which is 10, 20, 30 pages long.
Yeah, I've done the same as well. I'm just going to put onto the 1 minute as well. Let's have a look.
Well, unemployment is what's been the interesting number today, because it went up.
There's your 1 minute.
Largely because of what we in the past.
There's the drop, and there's the push up on the 1 minute.
This time it is kind of what the Fed wants to see.
Yeah, you got buy signals on gold and US 30 at the moment. Just get rid of that.
By 328,000, while the number of people
that's better than I can see. But it is a neutral support on the 5 minutes, so it's quite a decent pivot. We'll just watch. We're at heavy resistance on the 1 minute. That's why it's just rejecting around here. Look, because you've got resistance and that neutral support zone. You can just see where my line is there. Look, so we could get a bounce off on the 1 minute off that and back up. And there you go. Look, there it's trying to. There's the bounce, exactly where my dotted line is. Look, you see.
But we're not seeing people drawn back in by the fact that there's so many jobs.
Let's watch it push.
Well, and Randy, that's where I wanted to really finish up here and just get your impression of why the participation rate is going down, why it is moving in the opposite direction, despite the wage gains and despite the job openings that we see in the JOLTS survey.
Yeah, this is one of the great frustrations that the Fed has, and Jay Powell's been talking about this for a long time, of trying to get, why aren't we seeing more people come back into the labor market? And I think it's a variety of factors. There are many of the older workers and more experienced workers are saying, hey, I know a lot of people who didn't make it through Corona. I want to make sure to have time with my kids, my grandkids. So you've seen a much lower labor force participation by older workers, and a lot of younger workers are saying, unless I can get a job where I can sit at home and kind of pick the hours that I want, I'm not going to bother to come in. And so it's hard, and despite all of these openings, it's not enough so far to be able to draw people in. Part of that is because even though wages have been growing nominally faster than they have in the past, the real wages, the inflation-adjusted wages, haven't been growing that strongly.
Randy Crosser, thank you so much for joining us. It's just a joy to have you with us.
Keep watching. It's trying to push. Look, here we go.
Back in Chicago.
Look at pushing gold pushing up.
That gets us in front of our coverage that you will see Tuesday and Wednesday. Thrilled to bring you Bloomberg surveillance from the nation's capital for
excellent. I'm just going to close some buys on gold.
Election, and this is from Mike Allen and the team at Axios. President Trump.
Let's see if we get any more. Come on.
November 14 to start a 2024 presidential.
That was a nice push up.
Exactly shocking, considering that it is very,
I just closed 1, 2, 3, 4, 5 positions there on the buy.
Right after this midterm election, Tom, we are right into the presidential campaign.
And now we're 1171.
9, 10, 11, 12. Well, how's it going to change before we get to a supposed announcement from the former president? That again from Axios. Right now we go to Jeff Rosenberg, who was just wonderful on Fed Day, giving us the dynamics of a dynamic press conference as well. Maybe, Jeff, with BlackRock, maybe not as exciting as that press conference, but nevertheless, a job report of a fully employed America. From where you and your team sit, is this jobs report old news, present news, or indicate a buoyant future?
Yeah, great question, Tom. You know, I think it validates what we think.
That's another couple more closed.
Market, and that is.
It's really flashing around now.
So like aircraft, but upside down. They're creating lift, but they're creating lift in the opposite sense. We're pushing the tyres into the ground.
The only bit that actually touches the ground are the tyres, so as much downforce as you can have, it's just key to going faster through those phases.
Closed a few more out. Took a loss of 923. 7 and a 1, but we're okay.
Is that it is very, very slowly starting to show some effects of an economic slowdown.
It's 1176 after all that, so we didn't do much on that one. Let's see if we get a pullback sell now. We say a bounce off that level. It could be on the open, couldn't it? Easy that we and USD has done the same. Look, see the sell on the initial news, the pullback, and now it's just going to range around, as we know, ready for the open. We'll just set the open up.
You know, the most salient point I think here,
Bang.
and Powell mentioned it in the press conference, is the lack of labor force participation responding to this historic levels of openings.
And we'll just watch what it does on the open.
That's a problem.
That will switch to US 30 now.
To the Fed's tightening, and so they've got a lot more work to do. They're going to slow that pace, fine, but we really are not seeing the economic slowdown that's necessary for the Fed to get to that inflation slowdown. So this is a real challenge for the Fed and for
Let's look on the 1 minute and see. It's going to hit that 1658 and reject. Got a resistance here. If not, 1660, so it's around there. Look, it's going to reject. Hankin is still green. Once it touches that red, we know we're getting overbought. Buy signal was true though. It was good.
In this market, it's been a dramatic increase and restoration of yield for safe assets. You think back,
it's got my emails through. Take profit. Yeah, it's filled. Thank you.
Negative interest rate policy environment that gave us TINA. There is no alternative. Now there is an alternative, and so it's adjusting to where the opportunities are. The opportunities are in the very front end of the yield curve, where we're pricing in, as Lisa talked about a minute ago. You know, 5.25% peak Fed funds rate. Whether or not that turns out to be the peak depends on inflation, but the Fed signaled earlier this week to expect an increase in that terminal rate. The market's already there, so there's not a huge surprise when we get to the SEP. There may be more of a surprise on the inflation next week, but there's a lot of opportunity there because we've done a tremendous amount of work pricing in the normalization, the tightening, the movement to restrictive policy that the Fed wants to be at and are getting much closer to being at.
Yep.
They were going to see a higher than 5.25% Fed funds rate.
You can see now we're coming overstretched. It's going to hit some area of resistance very soon. ADX is over 30, so we're in a good position for some kind of sell. As and when we're overbought now, like I say, you can a continuation trade up to that 1660. It's pushing.
Peak expectation and therefore the peak of the Fed funds expectation, we continually move it out.
Just wait for it to hit the outer band, wait for that pullback.
That's the peak. If the inflation forecast finally
got no red candle yet.
Get that 0.3 in core CPI next week, you know, then I think 5.25 will be the peak. But there is a possibility here, and you're seeing it a little bit in the data. The lack of the data today in the payroll report, the lack of an expanding labor force, very strong wages.
Got 30 seconds and this candle closes inside.
begin a wage price spiral. And if that's the case, then the Fed may have to do actually much more than that 5.25 that's currently priced in the market.
What does that do to risk assets, Jeff?
Well, I think it's a challenging environment for risk assets. We saw this in the post press conference equity market reaction, that the Fed doesn't want to see financial conditions easing prematurely. They need financial conditions. Remember, the transmission mechanism is tighten financial conditions, then it affects the real economy, slows the real economy, and then the slowdown in the real economy slows down inflation.
Nice one. Caught another nice sell on that. Got an 82 and a 65, so it's another 100.
Then the Fed has to do even more, and that's why he pushed so aggressively back against that. You know, oh, the market is up. What do you think about that? And then he gave you the greatest hawkish hits to push back down the market. So in that environment, it's going to be challenging for risk assets.
Jeff, Ian Lingen just publishes at BMO Capital Markets, always wonderful on fixed income, and he makes clear that this report gives Chairman Powell room to wait. He can now comfortably wait for these inflation reports that we see before the December meeting. Do you agree that it's not that it gives him degrees of freedom, but that this report gives him the room to really wait and analyze price change?
Yeah, I would agree that this report is not changing.
Rejecting on that resistance looks really nice.
Expectations for the Fed to begin a step down in the pace of the increases, but not necessarily ending that pace of increase until they start to see the development in inflation.
Shorting from there down to there.
So they can slow the pace because they want to incorporate the Brainerd perspective, long and variable lags, that important change to the statement that we got earlier this week. That's about the Fed acknowledging we don't want to go at 75 forever. We don't want to overdo it. We want to give time for the data to show up. And I think today's report is in line with that market expectation. Doesn't really change it dramatically.
Are we going to go back to an era that was
going to retest that
last decade or so,
mid-band, you see, which will sit right on our moving average. That's our whole moving average there. Look perfect. So will it come back to that?
Is this a materially different decade coming up?
Well, this is the premise of your question is, do we go back to the
dropping again?
Secular stagnation?
Let's see if it hits that target.
If you look at market consensus expectations for interest rates, for inflation rates, there is that expectation built into market consensus. We would be highly skeptical of that outcome. There are significant structural changes.
We got a little frozen there on Jeffrey Rosenberg. I guess we'll exit there. We're going to exit
push down, beautiful.
Later, and we'll do it now. Thank you for that. And a frozanical moment with Jeffrey Rosenberg.
Frozanical?
It's a frozanical moment of it just, you know, it happens there. You know, you have that. And thank God to my left, I've got Michael McKee to save us before we go to Ira, Jersey. Are you going to freeze on us here?
I'm here in person, so I don't think so.
Well, so Mike, you've been having a couple minutes to really parse through some of the details. Anything stand out to you?
A couple of interesting things just that go
Let's
along
dip
with
on
the
them
news
futures.
lately.
Look at that.
Joe Biden's been wanting the oil companies to produce more. Oil companies say they can't find workers. There's only 400 people hired in oil and gas extraction in the last month.
400.
Wow.
400.
Could be a case of holding, wait for this push down on the open. Let's see, you know.
Situation. And we're also getting into the holiday season. I was just in a store and I wanted to buy a Thanksgiving card. I couldn't because they're all Christmas cards. At this point, the retail trade only added 7,000 total, and department stores and general merchandise stores lost jobs during the month. And the interesting thing is warehousing lost jobs during the month. Couriers up only a little bit. Well, what I'm wondering is if this is a seasonal problem, a seasonal adjustment problem, in that when we had the pandemic, we all bought online. And that pushed up the numbers of people doing retail and especially the warehousing kind of numbers.
There's the drop.
And now the seasonal
beautiful.
factors are kind of off. We've gone back, as Jeff Rosenberg said, to the pre-pandemic kind of hiring, and you know, this may not be an accurate representation of where we are.
Michael McKee, thank you so much for bailing us out of a Frozanical moment. 10-year yield 4.18%. We had a 4.76 on 2-year. Comes in.
We've got a red candle on the Hakanashi.
Futures up 34, and the VIX under 25 shows the oddities of the equity market. Ben Emmons just publishes and makes very clear we will see 5% yields. Ira Jersey joins from Bloomberg Intelligence, looking at the short-term paper, but also out where Ben Emmons is looking as well. Ira Jersey, how does our listeners and viewers' world change with a 5% 10-year and maybe with certitude a 5% 2-year?
Well, I think we get the 5% 2-year before we get the 5% 10-year for sure. And I think we're going to continue to see some yield curve flattening, because I do think
watching that rejection is nice.
Get higher and higher in terms of short-term rates and expectations that the Fed's going to hike now above 5%.
So you can move your stop loss now.
5% was going to be the ceiling, but you know, this data just keeps on coming in way hotter than almost every forecaster is considering. You know, as the Fed pushes against the rising inflation, we're going to have the long end just lag moves in the front end of the curve, and you're seeing that a little bit this morning, but not quite as much as I think that we'll get if we do see a pretty hot CPI report.
So how deep could this inversion be? We've been talking all day about the inversion in the 210 spread that goes back to 1982, and this question of what kind of depth of recession that portends. How deep could that inversion go?
Yeah, so
let's have a look at the pound dollar as well.
For negative 65 basis points.
On the 15-minute, you see, look, they're
kind of approaching those levels, but I think if the Fed
it just rose just nice and steady. The dollar obviously weakened on that. We got a nice, if you traded cable, that was a nice smooth trade.
I think you're going to end up with at least a negative 75 and maybe even a negative 100 inversion in the 210s curve. Which, you know, it's not unprecedented. We saw even a deeper inversion back in the 1980s, but the point is that the higher short-term rates go, probably the deeper that inversion gets. It doesn't mean that we won't see, you know, Ben Emmons' 5% 10-year yield, but I think we'll get there if, say, the Federal Reserve hikes to 6%, for example. So that's kind of the ratio. Call it a 50% beta between 2s and 10s, I think.
Ira, so many watching and listening have never experienced negative 75 basis points on the vanilla spread. What does that do to the banking system? Is that glory days for Brian Moynihan and Jamie Dimon in the banking industry?
Well, I think in the past, when banks did a lot more maturity transformation type of trades and you know, borrowed short term and then lent long term, it mattered a lot more. It matters a little bit less now because some of the Basel regulations have significantly shifted the way that banks do their business, and they actually issue a lot more debt in term space. So it's a little bit less important than it used to be. Now it still matters because there still are things like deposits.
See if we get another buy signal on
if you look at bank deposits,
pound dollar.
Their total funding, it's a lot more, and banks just aren't increasing the amount that they pay, the interest that they pay on deposits as fast as the Federal Reserve is increasing the interest rate. So banks are just still taking advantage of that maturity transformation, and NIMs haven't come down that much.
Ira, 10 seconds. Tottenham or Liverpool this Sunday? What do you think?
Oh, Liverpool has not looked good the last couple of weeks. I'm going to give the edge to Tottenham.
There's a buy signal again.
You can come back. Ira Jersey, thank you so much. Bloomberg Intelligence. We need to switch to the equity market because the bond market.
This is Mark. And this is a car, a sofa, a bag. But since Mark has been trading with Capital.com, he started seeing things a little differently. He sees a brand. He sees value. He sees an investment. It might go up, or it might
nice. Go down. Look at that. There's a nice little cheeky win on pound dollar on the 15. Beautiful. Look at that.
And start seeing the world differently with Capital.com.
Front and center is out front in terms of rates of change, but the equity market's there.
Sort of, and that's a question of whether the equity market is getting what the bond market is getting, and whether the messages somehow are missing each other in transit. Gina Martin Adams joining us, Chief
back on
Equity
gold.
Strategist for Bloomberg Intelligence. Is this labor market report good for stocks the way that it seems to be, at least in the knee-jerk reaction?
I think it's a net neutral for stocks.
Still nothing yet on that.
It confirms what we already know. That is that labor markets are
Stop
still
loss is going to be above the
tight,
band.
wages are still relatively fast.
We'll pull our TP back to that line there. Look, so it retests where it dropped before. That's the way to do it.
And that might lead to more weakness going forward. But I think it's a net neutral report, frankly. Think about where we were earlier this week on the equity market. There's been a lot of volatility in the interim, so I wouldn't attribute all of today's move to this report specifically.
Gina, we
I want to be on that line, don't I? Just below it. So it's got to be there.
People that you work with in the equity
If you're setting a stop loss, wants to be about there. Look,
the income statement
above that next points of interest line.
Into this absolutely historic time, where in the income statement is your team studying the most? Top line down to the bottom line. What's the mystery?
The most important point to watch in terms
It's kind of the bigger picture. You want that kind of pullback.
Is the operating margin line. Operating margins always trough before the earnings trough. Operating margins will always give you a clue
If it hits that inner band or the points of interest, look, that's almost back to where it was for the start of NFP.
Because many S&P 500 companies
That's the bigger trade to watch if you were holding.
On a year-ago basis. They're seeing operating margins fall. But also
US 30, that's on the buy. Again, nice buy on that. Let's see what it's going to do on the open. We've got 30 minutes to go now.
Always going to be in front of what you get on in the economic news.
Wicked. When you take the news event out, it's just a beautiful little rejection and up it pushes again. Just normal technical analysis, price action. It's just that news event that we managed to scalp that most people ignore or keep out of, you know.
We think that trough may come as early as the first quarter. That certainly is what's in analyst expectations, but there's a lot of volatility in the interim.
Gina, we've got to leave it there. Gina Martin Adams, thank you so much, and we'll look at that operating income analysis across Bloomberg Intelligence here in the coming days and weeks. Lisa, I've never seen 3 days like this. There's been some joy along the way. August of 1998, some early things in the 90s, etc. These 3 days, cumulative to the press conference, the ballet in London, and what we just witnessed today, it's the most unusual time.
I think framing it out, the idea of a 40 basis point 2-year yield 12 months ago to now like going to 4.75%, 4.73% highlights the regime shift and the unique moment that we're in, that suddenly everything has to reset at a new level. And the question is, what does that look like? And when do we understand the contours of that new reality?
I mean, we will see. And then, of course, to Washington next week.
Well, yeah, and to Washington in about a half an hour coming up at 9:30 a.m. Eastern. We do hear from Marty Walsh, U.S. Labor Secretary on Bloomberg TV and Bloomberg Radio. How do they really talk about a labor market still very strong when everyone talks about inflation being the foremost problem and you need to have a different scenario in the employment market? From New York, this is Bloomberg.
It is Payrolls Friday. Let's get you some reaction. Live from New York City this morning.
Yes.
Worldwide. Good morning, good morning. Equities positive by a little more than 1%. The countdown to the open starts right now.
The whole thing pushed up on that result, basically, and we just had the market manipulation on that bit there. That was it.
Is Bloomberg the Open with Jonathan Ferro.
Hence the push up on gold. So we're looking for this trade here for the open. This is what we want. We push back down again.
Live from New York, we begin with the big issue. It's jobs day in America.
Jobs out of the employment report.
Hey, this is a pretty strong employment report.
The labor market is still.
So no positions open at the moment. We're just waiting for the open now. Probably going to go in on US 30. We'll watch this gold. See what's going to push in higher.
The next box you need to check is labor.
Zoom across. Look, you see you've got your next level.
I think they're going to continue hiking. We are watching for signals of a shift. You check that box
Right up to 1682 even. Look at that.
Looking at job
set a level there.
They're picking up.
You see sort of weakening demand in the ISM surveys.
That's your next level.
Right now, there's nothing to suggest.
We're not seeing cracks in the labor market
Let's
yet.
get rid of that for now because we're not in the trade. This is what we're looking for if that move happens.
I'm not sure I can do that. Peter Cheer had the best remark this morning so far. It's hard to make good or bad out of this report, because there's a little bit of everything in it. 261,000 jobs created. That's the bad, at least from the point of view of the Fed, which would like to see things slow down some. And look at the revision to September up to 315,000. Then you go down the line, and the unemployment rate rises to
Let's go back to US 13. We'll focus on that for the open.
Into the labor force,
there we go.
which the Fed was looking for,
Let's
but
bring up
because
1 minute.
more people lost jobs, and a lot of people who were employed are not working this month. The labor force shrank during the month. The participation rate falls. Now, the only good news here at the bottom is that average hourly earnings fell. Now, that's not good news if it's your earnings that didn't go up as much, but it's good news for the Fed because it suggests maybe some progress against the inflationary impact of higher wages. Where the jobs will manufacture.
That's what we're looking for. So again, I wonder if we're going to get a rejection, a pullback on the open. Back into our bands. We're all bullish at the moment. Momentum's pretty low though, as you'd expect.
Reporting increases in the hundreds of thousands not so long ago. Only 6,000 jobs added there. And of course, that last one, you're not going to be surprised to know. 8,700 jobs lost in real estate. Mortgage brokers in the last 6 months down 30.
Right, there you go. Look where the jobs are. That's good chart to show.
Average hourly earnings is an interesting number because it's
blows
not
past
the
estimates.
Amount of compensation that people get. The Fed likes to look at the ECI, which came out last week, but these numbers are, at least you look at the graph, moving slightly in the right direction. You'd like to see a little bit better than that. And that leaves us, John, with the question of where do we go from here in terms of the Fed. At least the markets are thinking that we are going to see a higher terminal rate. It's gone up just a little bit in the last couple of days since Jay Powell was last with us. And they're thinking that the Fed is going to be somewhere above 5%. At this
5%.
Point, between 5 and
see, that will push push US 30 up even higher.
And higher than even some in the markets had been predicting before we went into this week.
And for many in the last 30 minutes, this jobs report just not a game changer. Mike McKee, thank you, sir. And next week, all we'll be talking about is CPI. CPI next Thursday, November 10th. Futures right now positive.
Yep, CPI next week.
After the jobs report, then bounced back. Futures up by 1.3%. Similar move in the bond market. Yields much higher, then faded. Your 2-year got very close to 480, now back down to about 471-ish. Similar story in the FX market. Bit of dollar strength for a moment, a heartbeat, then ripped again. Euro strength, dollar weakness. Euro dollar 98.59 as session highs there and thereabouts. That currency pair up by a little more than 1%. Rick Reeder at BlackRock joins us now. Rick, I've given you about 34 minutes to try and make sense of this one. What's your big takeaway from this morning?
John, I need more than 34 minutes. Listen, I think this jobs report is similar to what we're witnessing in the economy. You've got a mix of dynamics at play. I mean, when you look at that service sector number, you look at particularly leisure, or you look at education, the numbers are strong. I mean, the service part of the economy is still in really good shape. We talk about, Michael said, we're coming off a little bit. I mean, listen, the numbers are slowing from, you look at the 3-month moving average of jobs versus 6 months versus 12 months. We're moving in the right direction. We are slowing. But the service sector, which is 80% of the hiring, is still in very solid shape. I was looking at today some of the airline numbers, the amount of hires they're making. Leisure, hospitality, restaurants generally, although some back off today, it's pretty solid. I mean, and this is why you've got a Fed that's willing to over-tighten to deal with some of this.
Is that your takeaway, Rick? There is a commitment here to over-tighten from this Federal Reserve.
John, and I have to say, when you look at that press conference, that was the thing that blew me away. When you actually listen, the Fed was too easy, too long. I think you said it. We've said it on shows prior. You think about where we were in March, 0% funds rate and doing QE, and now we've got the most historic set of rate rises while draining liquidity. Gosh, I think over-tightening. While the chair talked about the ability to then come back and use his tools, I don't think that makes any sense. I think you've got to be, I mean, we've moved a historic amount. You see it in the housing market. I mean, boy, these are historic drops in terms of the rate of activity in the housing market. You'll see that price flow through. You're going to start to see it in auto finance. Clearly, you're seeing it today. Gosh, I think the Fed's got to be careful about, quote, over-tightening. Because when you think about what's happening, you have an economy that's operating at a pretty good place. You're closing the income gap. Wages are going to start to come down. That being said, they are offsetting an inflation shock. That is really important, particularly for lower and middle income consumers. So listen, I think the Fed's got to be really careful about that comment about over tightening. I don't think we've got to keep veering the boat from one side to the other side. They've moved a lot. I think
yeah, we'll climb. Yeah,
they've made have been brilliant this year. Going further to over tighten, I don't know. That one was I thought a bit excessive.
Well, I'm with you, but we've got to question that underlying assumption, and that underlying assumption, in very simple terms, is that they still believe, this chairman believes, that the risk of doing too little outweighs the risk of doing too much. Now, Rick, if you think they're wrong, and if you think the risks aren't that asymmetric, what are the consequences for this market going into next year?
So, listen, I think you've got to manage your risk with the dynamic. So there's the Fed, the New York Fed did a great piece on R-star and double R-star. You think about how the financial economy reacts to and what the equilibrium rate is in the financial economy relative to what it is in the real economy, particularly a service sector that's not as interest rate sensitive, which is what 2/3 of consumption is as an economy. But the financial sector becomes increasingly sensitive to these moves in interest rates. So what do you do with it? You got to be really careful. When you think about going into next year, where do you take the risk? How do you take the risk? Where's your convexity to the upside? We've talked about running a lot of cash in portfolios. We're starting to use our cash because you're getting, and we've talked about this, you're getting front-end yields that you can buy 1-year corporate paper at 5%. You can buy AAA securitized at 6.5, 7. These are incredibly attractive levels. You got to just be careful about how much, where your convexity to the upside is and the risk you're taking. Do you want to do a lot of EM when they could over tighten? Do you want to do a lot of down the capital stack when they're potentially going to over tighten? Big considerations going into next year.
Well, Rick, this was your line going into next year. Wall Street Journal over the weekend, you spoke to them. Great piece, by the way. It was you and others.
Thanks,
Here's the quote. I'm more excited going into 2023 than I've been in a really long time because we're going to have so many different opportunities. What is different about this moment in your career, Rick, relative to the last few decades?
So thanks, Jonathan. So the yields, I mean, my AAA assets, you think about in my career, the ability to buy AAA assets at 6 to 7%, the ability to not take a lot of interest rate risk, not take a lot of credit risk, and capture these yields in an environment where volatility is going to be high, you're going to create opportunities across the markets. Listen, if the Fed is willing to go that far, then you're going to get some defaults accelerating. You're going to get some opportunities in distressed markets. You're going to get some cap structures that are going to be interesting to do some refinancing around. That is an exciting period. In the interim, we can clip yield in so many different ways without taking a lot of risk in the portfolio. It's a pretty good environment, John. You think about how many months were we on the show talking about negative interest rates?
Yeah.
Negative interest rates, which now you're getting incredible yields in high quality assets. So I don't know. I'm pretty excited about next year and the dynamism that this is going to present.
Rick, can we live with it though? Can we live with Fed funds somewhere between 4 and 5 over a sustained period? Do you think we can, or is this just a moment in time?
Jonathan, I think the answer is it's I hate to be wishy, it's unclear, and this is part of why I think the Fed needs to be really careful about how far do you go, because we haven't seen this fast a tightening. We've never seen a pandemic reopening. Listen, the goods part of the economy is in recession today, no question about it. Service sector is going back, it's moving back to a trend because you had this extraordinary slowdown during pandemic. So it's pretty unclear, and this is part of why I think, gosh, after you move this much, you have to sort of think about, gosh, the real estate market. I know I'm doing this in a piece today. There are about 2.5 million people attached to the real estate market in this country by the quoted metrics. But there's a multiplier of about 9 and change times of that. It's about 21 million jobs attached to real estate. Think about
futures rise. Look at gold.
Tax attorneys. You think about
in that range now, so it's waiting for the open to be the springboard, either to just clip that 16,666 or to pull down, as we say, going back into our bands on the 1 minute.
Can the economy withstand?
We're 84 on the RSI on the 5 minutes, so we're well oversold, so we're due a correction. So that's what we're going to hold for.
Do you think this is the calm before the storm? And the reason I ask that question is because Bob Michael at JP Morgan thinks it is. His view right now, despite what's happened with fixed income, he just wants to sit there and high quality
I agree
assets,
totally.
that people are going to want.
I think we'll see the same probably on US 30 as well.
Do you share a similar view at all?
So Listen, I think there's a backdrop. So you take last year, nominal GDP was about 11. Year on year, nominal GDP, again, most of it coming from inflation, is year on year still running at a close to 9. Again, much of it inflation. Boy, you solve a lot of problems when you have nominal GDP, particularly in a highly indebted economy. So, and you've got a service economy, it's most economy, it's operating at a really strong level. If China reopens, you get global growth that starts to improve. So, listen, I think the base case is that the system works its way through. It's part of why I don't think the Fed needs to be so aggressive in this.
Pound dollar, yeah, still pushing high. Look, that was a nice.
I think, we've not seen this type of rapid tightening before. You've never seen that, quite frankly, you think about the geopolitics.
Nice buy signal, spot on, that was.
We're talking about.
In fact, the sell here was spot on, the sell here was spot on, the buy here was spot on, so that was all 3 trades you could have grabbed there. Look, you could have grabbed 15 pips on the sell there. You could have got 38 pips on the sell there, and the buy here I took just 5-6 pips, but you could have held for 30 or 40. So again, that's a good one. Popping back up to that 113 level up.
Thoughtful about where you're taking convex risk, and
so the candle's inside the zone there, so that was a perfect candle to enter on.
More volatility than expected.
Well, it's great if you were holding cash coming into this mess, and I know you were holding a lot of cash coming into this mess. Rick Reeder, thank you, sir. Over at BlackRock. Appreciate it, Rick, as always. Yields, 2s at 470, very close to 480 a little bit earlier.
Let's put the NY line in there now.
1.4%. China reopened.
Ready for that trade.
Conversation, the rumor mill, it's out there. Still no confirmation from the Chinese, but look at this move in crude. Brent crude up 4% to 98.50.
And almost the same.
92.30. Coming up
the
on
same level.
Corporate America pumping the brakes on high.
Asia, New York.
The problem is demand is slow. We're expecting all of this.
So that's where we might expect pound dollar to pull back to. Here.
That conversation coming up with iCapital's
But we want to wait for that first half an hour of the open, which should be there. Look.
Review on the payrolls report coming up shortly.
Formula One cars are like aircraft but upside down. They're creating lift, but they're creating lift in the opposite sense. We're pushing the tyres into the ground.
The only bit that actually touches the ground are the tyres, so as much downforce as you can have is just key to going faster through those phases.
Aerodynamics is the prime performance differentiator on a Formula One car. So that's also why we dedicate a lot of resource, a lot of focus on aerodynamics.
So we've got all those charts set up. Like I said, we're going to have a look at US 30. On the 5 minute, we've got our grid. You can see there where the next level is. Which will be right outside the bands. Right here, look. But you can put it on there so you can see it on the 1 minute as well as the 5 just below. There you go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than. You
can see it's ranging. It's nice. It's either going to explode up or we're going to break back inside our zone. Look, we didn't quite make it, and we need this to be above 30. So.
We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
So we're just waiting. 10 minutes to go.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Businesses were catching up with demand over the past year. They were building inventories, they're raising production, they need employment for that. The problem is demand is slowing. And as we head into the coming year, we're expecting all of this policy tightening to hit. We'd expect about 2 million job losses net over the course of 2023.
The labour market proving resilient in another strong payrolls report. Corporate America telling a different story. The list of companies tightening their belts growing by the day. Amazon, Apple hitting pause on hiring. Lyft, Warner Brothers delivering the latest round of cuts. And Credit Suisse doubling down with a fresh round of job cuts themselves. Kaylee Lige struggling to keep up in just the last 24 hours.
Yeah, I mean, at least for Credit Suisse, John, that's just as much about its never-ending series of struggles as it is the macro picture. And you could say the same thing about Twitter, because Elon Musk overpaid $44 billion for the company and now wants to cut costs, which is why at 9 a.m. Pacific time, so less than 3 hours from now, 3,700 Twitter employees could lose their jobs, roughly half the workforce, although there will be some legal battling within that, considering there's already a suit in which workers
Cool, we've got 10 minutes to go, bro. Final trades of the week. So no other news or anything, we'll just see what the move we get. Market reacts. We've got gold still attempting, still going higher as we thought, hitting that. Look at that, it's hit exactly where we said, 1666. We're over 86 now on the RSI, so we're definitely waiting for sales only on gold. And still a bit more movement. A US 30 could still pop higher on the open, we will see.
Of its workforce, and of course, as broken this show yesterday, Stripe is laying off 14% of its employees. So it's a literal laundry list, and it extends beyond the tech sector as well. Highlighted in a report from Challenger Gray and Christmas release yesterday.
After it, yeah.
Job cuts announcements were up 48% year on year in October. Actually, the 5th straight monthly rise in a row. And they say more cuts are on the way as companies anticipate a downturn. The question is, John, when does all this corporate behavior start to show up in the economic data in a more material way?
We've been asking the same question all week, Kaylee. The same question all week. Kelly Lige, thank you. Joining us now, iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, first to you. Let's get your reaction to this jobs report, then we'll build off from that. Your thoughts?
Well, it was very interesting, and there's clear divergence going on between what's going on in the household survey and what's clear is that the economy is weakening, and you're starting to see some parts of weakness in the labor market as well. I mean, the key difference between the two surveys is that you have the self-employed workers, the household workers that get captured in the household survey, and that clearly shows that you have had over 300,000 of job losses in that. So I think that is a sign of what's to come. To your question that you were just talking about, I think we're going to see these layoffs that we were just witnessing show up in these numbers over the next few months. And look, you can't not cut jobs in this environment because you had profit margins that are starting to shrink for corporate America. And that was very much showcased by big tech, but other companies as well. So demand is slowing. You've hired a lot. So you're going to have to cut some jobs. Then housing is just completely
like you say, you're totally right.
And as Rick was just mentioning, there's so many jobs that are tied to the housing market. I think it's inevitable that we see some of those job cuts, unfortunately.
Still all green. Look at that. Look at the RSI. Look at that on the 1 minute. Ooh, we're high. We're high.
Is going to show up in the other survey as well.
Mike Collins, your reaction, sir?
Yeah, John, I think this continued really strong labor market data.
And I think on US 30 as well.
Old news, as Anastasia said, you know, looking out 6, 12, 18, 24 months, which is what, you know, good long-term investors do. I think it's going to be a very different picture, right? We are going to have a landing. The big question that you and we are all asking ourselves is it a soft landing / maybe mild recession or something much worse? But either way, I think earnings are coming down due to profit margins, demand coming down. Yeah, the service sector is robust. Business travel is back. Restaurants are full. Planes are packed, right? So that's a good tailwind. This reopening trade, not only in China, but in the U.S., I think has some legs to it. So there's definitely some credence to the idea of a moderation in growth from here. You know, maybe we get, 0 to 2% GDP for the next year or two. I think that's a really good outcome. I think that brings inflation down into the 3s. It probably leaves the funds rate
6-7 minutes to go.
4, not 5, right?
Logged
so I
in.
think, to Rick Reeder's point, I think 5.25 is going to be a big overshoot in retrospect, and the funds rate will ultimately land somewhere lower than that.
Mike, I keep hearing short and shallow. What are the assumptions that underpin that assessment? Where does that come from?
Yeah, a short and shallow recession, John, just assumes that, you know, corporate earnings come down a little bit, but they don't go to negative 10% year over year next year. They go to 0, right? And default rates don't go to
US 30 as well, look.
They go to 3, 4, or 5. You know, that's a very, and the unemployment rate goes from 3.5 to 4.5, not to 6.5 or 7. Those are the two scenarios we're dealing with. I mean, unfortunately, the probability of each of those two scenarios, the soft landing and the harder landing, are, I don't know, maybe it's 50-50, right? I mean, I actually think the soft landing is a very probable scenario, but in either scenario, you end up with a lower interest rate structure than you're dealing with right now.
That's the world we want. Anastasia, any indication that that's the world we'll get?
Well, I think a soft landing at this point probably does mean a mild recession. And I do think that actually might be possible, because one of the differences between a true hard landing in a financial crisis and a soft landing in a mild recession is that excesses need to be corrected. And if you had leverage that accumulated in the system, and that leverage needs to be reduced, and that leads to fire sales of assets, and that leads to widespread dislocation, I think that's what really causes a really tough recession and a truly hard landing. And I think the good news today is that we don't necessarily have that today in the economy as a whole. We have pockets of leverage that we'll point out.
Just ranging around as you'd expect.
The U.S. consumer, for example, this is not the global financial crisis. You had the debt service for the U.S. consumer that is half of what it was during GFC. So you have a lot more resiliency on the
chance for it to move on back up
you have a
to
lot more resilience, I would say,
377.
on corporate balance sheets, as well as leverage is in check and cash balances are really quite high. And then the banks are well capitalized as well. So I don't think this is a scenario where you have a slowdown in economic activity, a recession, maybe negative earnings, and that leads to this vicious cycle. However, there are pockets of leverage that have been accumulated, and I would point to the leveraged loan market. That tripled in size in the last number of years since the financial crisis. It's the same size as high yield market right now, and high yield credit quality actually improved, but leveraged loan credit quality on the index basis has deteriorated. So I worry about some of those companies that coming into the year,
nice push up, look.
the rates to rise.
Why? Because if you look on the 5 minute, you've got that area of support here, look.
Cost of 4%, over 4%
there you go.
rate. So that's the part of the market that I'm particularly
So that's the area of support from the 5 minute on our points of interest, and that's why it pushed back off. It would have entered a sell if that had been broken.
Lucky to have them with us. Going into the opening battle, equity futures up by 1.35%. The Monocles up next.
The market wants to push down, as you can see, just looking. We're still green on the MACD. See it push up nicely. Look at that 3-4. Some big pips potential. It breaks out of this zone, breaks out of this area of resistance here. Look, it's almost like in a channel, a nice channel. Look, bang. So I want to see price break above or below.
The reason that I was interested in doing this in the first place was a much bigger challenge than
and we've got that potential there, you see,
something in the fashion industry as a narrow opportunity,
which is what you'd expect, as we said, with it being hotter or hotter than expected.
Around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic, and the hides from
no, not yet. No, they're not adjusted them. No, 261. Oh yeah. No. Consensus was 200. Yeah, they didn't. Yeah, revised. Look, there you go. Yeah. Look, last month they revised it to make it look like it was actually lower. I don't understand it. It's just.
And grab that and use that to tell a totally different story and compete on a totally.
So that really should be red, is what they're saying now. It's a better than expected figure, but actually it's not. Just so they can pat themselves on the back and say we were right. How can you be 60,000-70,000 a month later? Whoever counts the figures just can't count. Yeah.
4 minutes away from the opening bell, equities at 1.5%. Let's get you some morning calls. Let's begin with Piper Sandler upgrading Arista Networks to overweight, highlighting the company's impressive earnings and long-term growth strategy. Oppenheimer downgrading GoPro to market perform, expecting macro headwinds to continue weighing on consumer demand. And finally, UBS downgrading Teva to sell, forecasting significant downside to estimates with the company's CEO.
We've got 1 minute to go.
Next year.
Yep. Dinner, lunch for me after this.
The Labour Secretary Marty Walsh on the payrolls report. That conversation up
Yeah.
the opening bell just around the corner. Futures
Cocktails this afternoon after all that. Gonna go and sit in my local cocktail bar for the afternoon. Ooh. Steak time. Right. Let's just watch and see what happens on this then. So 30 seconds left. So we're well bullish on the moving averages, on the whole moving average, MACD, everything's pointing to a further upside, but we just don't know if we're going to break out the zone and break back in. We'll wait and see. 10 seconds. Let's wait for that move. See what reaction we get.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization.
So nice little move up, nice little push up. Let's see if we get a rejection now.
This is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this
like
DOGE
DOGE.
distributed to the end consumer.
10 seconds.
The grid of today just isn't equipped for renewables. So a new kind
He's
of
going to
grid
break out of that
is
zone,
starting to take shape.
push higher.
The supergrid.
Yes, look at that, beautiful.
The world like Bloomberg.
Rejected right off it.
Bank of England just stopped oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched
Yay,
reach and
very good.
resources from more than 120 countries.
Nice little scalp on that. Just $20. Got the buy, got that sell. We'll just wait and see if we break this zone here. Wait for it to settle down. Just watching the 1 minute there, look.
It's a great question. It's a great question. Great question. Great question. Great question. Great question. That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions. Why do
Formula One cars are like aircraft, but upside
That's
down.
that area of
They're
support you
creating
see.
lift, but they're creating lift in the opposite sense. We're pushing the tyres into the ground.
The only bit that actually touches the ground are the tyres, so as much downforce as you can have, it's just key to going faster through those phases.
Aerodynamics is the prime performance differentiator on a Formula One car. So that's also why we dedicate a lot of resource, a lot of focus on aerodynamics.
do the biggest names in business choose Bloomberg?
That is a great question. It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top expert.
Best question you get all night.
23 seconds away from the opening bow this Friday morning.
Yes.
Good morning to you. Equity futures positive, coming off the back of a 4-day losing streak on the S&P. We're up by 1.6% on the S&P 500. Post payrolls, upside surprise, maybe shaken up by a higher unemployment rate as well. Nasdaq futures high too, up 1.9%.
Push down, look nice to see.
Before today though, down more than 7 percentage points. We're trying to take some of that back. That's the opening bow. Switch at the board and get to the bond market. We look a little something like this on a 10-year, 413.95.
Yeah.
It's down by almost a basis point on a 10-year maturity.
You said you're waiting for that rejection. Look, RSI is 77.
Before payrolls, post payrolls at one point very close to 480. Right now down about a basis point on the session. Let's call it 171, 471 rather, on a 2-year. Outside of that in foreign exchange, euro dollar. Look at this for some dollar weakness across G10. Euro dollar 98.71. Euro dollar up by 1.25%. And China, $92.12 on WTI. We're higher by 4.5% on the session. Not just off the back of this story in China driving the commodity market, the equity market too. Fresh reopening hopes lifting Chinese stocks.
It's all going to drop a bit more.
Reports saying China may be planning on substantial changes to its COVID policy and scrapping rules that penalise airlines for carrying virus cases into the country. Kaylee Lyons has more. Kaylee, this has been a story
Come back
for
into
us.
that zone. Be nice if we got a signal.
It has led to explosive moves in the Chinese markets in Asian sessions, including the Hang Seng China Enterprise Index, which had its best week since 2015, but it has carried right over into U.S. trading with those ADRs of big Chinese technology companies charging higher early on in this session. Alibaba up 10 percentage points, as is JD.com and Neo. Baidu up 11% as well. These are huge double-digit moves for companies that have seen a lot of volatility as of late. And of course, part of that volatility related to the regulatory environment as well, not just the regulation from Beijing,
Still pushing up golds on that resistance.
Around the auditing of these companies that are listed on U.S. exchanges. We got good news on that as well overnight, though. In addition to all the optimism about reopening, inspectors finishing their on.
There's 30 rejected off our trend line. Look, as you can see, push back up.
So that is leading to some optimism.
Off it goes, back up again.
All get wrapped up pretty soon, and that the threat of being delisted from U.S. exchanges no longer is going to be an overhang on these companies. But of course, an overhang it has been, in addition to COVID-0 and everything else, why the Golden Dragon China Index, HXC, is down about 77% from its peak in February of last year. But I would note that we've seen other high beta plays following that same pattern. The SPAC Index, for example, or the IPO ETF, even the ARK Innovation ETF, which is the poster child for growth, high multiple companies. All of them have seen downward decline, John. But of course, for Chinese companies, it has been very, very difficult. The picture, though, may be getting brighter, although we're still waiting for definitive.
Yeah, we're just going to go another 5-10 minutes, see if there's one more trade or not.
Kelly Lyons, and if we get that confirmation,
just wait on this gold, see if there's anything on this gold.
Because we unravel some of those supply chain issues, or whether it's bad news. Bad news because we push a surge of demand through this commodity market. Kaylee, which one is it?
Well, I think it may be both. And it's good news on the growth side because this is the second largest economy in the world. Perhaps it can shore up growth as we face an economic slowdown in other areas. But at the same time, if you have an unleashing of Chinese demand in an already supply-constrained world where China has been offline, that's not good for the inflation picture. And that creates a very difficult, complicated outlook for central banks like the Federal Reserve, especially when the labor market isn't slowing down either.
Kelly Lyons, thank you. Let's whip through the price action on Brent crude, 98.41 off the back of this story. I think that is the story right now, the prospect of China reopening, driving a bid into copper as well in London. LME copper is up by more than 6% on the session. I'm sure you're interested in where WTI crude is this morning. WTI 92.23, up by 4.6%. For the broader equity market, we look a little something like this on the S&P, up by about 1.3%. Healthcare is lagging, still positive though. Leading is energy, up by 2.3%. Surprise, surprise. And post payrolls, your bond market unmoved on a 2-year now. Was pushing 480, now at about 4.71%. From New York, I'm pleased to say that joining us now is U.S. Labour Secretary Marty Walsh on TV and on radio. He joins us from Washington. Marty, fantastic to have you with us on the programme, sir. First, on this show, to respond to this payrolls report. The big question for many of us right now, Secretary Walsh, is how much you think this labour market needs to cool to help get inflation lower.
Yeah, that's it.
Well, I think that,
just find out what works for you, stick to it, just trade 2 or 3 things and that's it. Trade at the same times a day and keep practicing, and that's what you got to do. Totally right.
As we move forward here, I mean, we're seeing there's still jobs available out there. We're seeing the wages have gone up a little bit, a little less than last month, but we are seeing gains in those sectors that still are hiring people that need people to work in them.
The question many people are asking is whether higher unemployment is a price worth paying to get inflation down. Secretary Walsh, you and I have talked about that. That question has taken on renewed importance this week after some of your Democratic colleagues down in DC have sent a letter to Chairman Powell. Do you think higher unemployment is a price worth paying to get inflation lower?
Certainly, I don't want to see high unemployment because I think too many people in this country need to go to work. They're seeing opportunities where workers across the board average of higher wages right now for 4.7%. I think this month the wages are at.
So it's 30 range, and you see between that range, you can see here, look, just as it isn't just doji's, morning stars, whatever, just indecision candles, no real move yet. We're waiting for a break.
Times now, but in very different economic times, and I certainly don't want to see our unemployment rate go high. 3.7%. We've been averaging between 3.5 and 3.7% over the last, I think, pretty much the last year, and that's a good place to be.
Well, what's the mechanism for that to happen?
As far as, excuse me, what?
To get inflation down without unemployment going up.
Well, I think, you know, the Fed has raised rates. We're seeing a little bit of steadiness now, a little bit of cooling off. We're also seeing opportunities, as I mentioned. We're starting to see signs of a slow and steady economy. I think we're getting back to pre-pandemic where we were. We're not going to continue to see these gains of hundreds of thousands of jobs every month in our economy, because eventually, you know, we're going to run out of people to fill those jobs. We're seeing the supply chain. I didn't hear your whole segment right before this, but as China opens up, we're going to start to see more supplies coming across the ocean. We're seeing pressure on gas prices coming down a bit. We need to continue to stay focused on our gas prices, our natural gas. We need to continue to bring costs down at the kitchen table every possible way we can, and we just got to continue to do it month over month. There's not just one quick fix to it, as you know, and you guys talk about it all day long. There's lots of different things that have to happen here.
Well, the Federal Reserve's talking about causing pain. Chairman Powell talked about that in Jackson Hole, Wyoming. He said, well, higher interest rates and slower growth and softer labour market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Secretary Walsh, what would you say to those that may say to you that you're not being upfront about the pain that we need to go through to get inflation down?
Well, I could say this. People went through a lot of pain in this country in the last 2.5 years with the pandemic.
There's the break.
People lost their job. People were concerned about what the future is. And we're living in a very interesting time coming out of a pandemic. And I think that people are feeling pain. They're feeling pain at the kitchen table. And we have to do everything we can as an administration. The president has passed legislation, Inflation Reduction Act, that long-term will help us bring down inflationary pressures. We're working on supply chain issues to bring down inflationary pressures. The Fed are doing what they have to do to bring down pressures, and we have to continue to work as an all-government approach, if you will, and do everything we can to bring those pressures down at the kitchen table. I think by having unemployment rates around 7-8%, that's a lot of unnecessary pain that people in America don't need.
Gold
right
as
now.
well, look.
People that are working won't need that.
They say all coming back down to where the levels were.
No, I'm not there yet. I'm one of the people that hold out, saying that I would like to see the unemployment rate continue to stay where we are, even go lower if we can, and work other ways through this inflationary pressures that people are feeling.
I've got to put you on the spot there, Secretary Walsh. How does unemployment go lower and inflation comes down too? How do you think that happens over the next 12 months?
I think that people are trying to compare this economy to what we've had in previous economies. We've heard people talk about on shows all across America, and people in boardrooms talking about recessions and comparing this moment in time to past times where we had recessions. It's very different. It's a very different period of time, and we've never seen inflation at such a high rate and unemployment at such a low rate in the history of our country. So we have to just continue to do everything we can, use all the tools, all the mechanisms we have to bring those costs down. Some of this was caused because of a pandemic, because of supply chain issues in the very beginning. Part of this is because of gas prices. You know, this is a worldwide crisis that people are feeling with inflation and things that we're doing here in the United States. We are bringing, I think we're being a little more successful here in the United States than other parts of the world.
You talked about the mechanism. Forgive me for calling that a lot of word salad, because it felt that way on my side of it, listening to it, Secretary Walsh. You talked about the mechanism for this to happen.
Yeah.
Yes, unemployment is very low.
Yeah, thank you so much, everybody, for joining us, and we will be back for more live streams next week. Now Justin's back on board. It's good to have you back, bro. I've enjoyed it. Yeah, you take care, and
world we
happy
have.
happy
Is it gonna
trading.
work?
Take care, everyone. See you soon.
I'm not an economist, number one.
Bye.
And I think that has to be very clear.